It's a great pleasure to be here and to have an opportunity to speak to a business-interested audience about the things that I've been talking to academics here in Canberra and today here in Sydney about the past couple of days. The work we've done on this topic of Chinese outbound investment at Rhodium let me say something about it. It started with an idea 4 or 5 years ago that there were some deals starting to happen around the world that didn't make sense based on prior assumptions about how China worked. Up until that point, China didn't do very much value added anywhere but in China. If they could take ore home and process it in home, do any value adding possible at home, they would do it at home. And then we started to see a few deals that didn't really make sense to us. One in particular was an attempt by Baosteel to do a slab steel processing facility in Minas Gerais, Brazil. And it caught my eye. I handed it to a graduate student named Thilo Hannemann to spend a semester working on. And he came back with a paper. We looked at the results, and there were new forces at work. The commercial logic, energy prices were still very high at that point. It was just before the collapse of oil prices. And it turned out that for Baosteel, bringing back 1 boatload of semi-processed steel and slab versus bringing back 3 boatloads of ore made so much commercial sense due to energy costs at that point that they no longer felt the imperative to bring everything home, to process it home, just for the sake of adding to industrial production stats back in their home jurisdiction. But that was fairly new, that a state-owned enterprise was putting profitability in sort of a sophisticated way ahead of other prerogatives that everybody assumed was going to explain the behavior of Chinese companies. So we just got lucky, in fact, because it was around 2008, 2009 that we first started to see the takeoff in Chinese direct investment in advanced economies. It had been going on since about 2003 in resource extractive opportunities. I'm going to come back to that in just a second. But fast forward 5 or 6 years from then, we were lucky enough to kind of start thinking about how we would analyze this issue if we wanted to analyze it, with a little bit of a head start on it even being that interesting an issue, such that by the time it became an interest of the White House, for example, to put it on the agenda for discussions with then Vice President Xi when he came to DC about 2 years ago, we had something to say about it. How do we do that? We just started counting up every single deal that we could identify that had been done by a Chinese-related entity in the United States. And before long, we got to the number we're at today, which is about 675 since the year 2000. We found that with some hard work and some time, we could code whether it was a government-driven owned company or not a government company. We could figure out the sectoral patterns. We could figure out the state-by-state patterns. There's a lot of things we haven't started answering yet that are brilliant, dissertation work or commercial work yet to be done. The financing structures around all those 650 deals. Everybody thinks that we've kind of finished the process of doing a good analysis of the U.S. case and the European case, but we haven't done a good job of describing the debt equity mix, whether it's local project lending facilities or it really is money coming across the border. The Shuanghui Smithfield pork deal, which is a hot deal right now going on in the States, is being financed almost entirely by Morgan Stanley, right? So that won't show up in balance of payment stats as an outflow of capital from China, inflow into the U.S. It'll show up as a local project loan or a series of loan structures from Morgan Stanley, probably onshore U.S. financing. But it's an acquisition of a U.S. asset by a Chinese entity, or actually a semi-Chinese entity that's mostly controlled and owned by international private equity investors. So a lot more to be said about this stuff. And as much as we've done at Rhodium and given credit for doing a lot, there's so much more that's worth doing that can be done. It's kind of a wide open street for motivated folks to do more on this issue. And I'm happy to talk more about what I think would be interesting to see more done on in the Q&A. But what I thought to bring for the topic to chat about for 20 minutes or so is whether this surge, this upturn in Chinese direct investment is a sign of China's strength and taking over the world, if you will, or in fact the opposite, a sign of some of the weaknesses and limitations back home in the domestic market that has led to a new logic to putting the money abroad rather than just putting it to work at home, where, of course, Chinese companies have a home court advantage. That's where so much of the growth in the world is taking place. Why would you take the money to the old world and put it to work there? So we're going to talk about this. The headlines certainly play up the theme of a strong China going out, taking advantage of European stumble, American stumble, low cost of Chinese capital as a comparative advantage, allowing them to go out and take advantage of opportunities. There's a stock of between $400 and $450 billion of Chinese direct investment around the world today. Almost all of that's happened just in the past 10 years, the past 5 years in particular. Projections are by 2020, our best guess is about $1.5 trillion US stock total over the years will have built up overseas investment by Chinese firms. Some of the projections to 2025 are looking more at a $4 to $5 trillion number in terms of direct investments placed. So we have this narrative of strength, and we have very much a narrative of strategic intent by the Chinese state, by the Communist Party even. It's assumed that these are all SOEs going out according to some kind of machinations and plans made in Beijing that are going out there. But while there's certainly strength among many Chinese firms, and there's certainly strategy in Beijing, in fact, when we do the analysis of these investments, it looks more to us like strategy is playing catch-up with a commercial imperative, almost an existential imperative for Chinese firms to go out and do this stuff, which they would rather not have done if they didn't have to. Of course, all of FDI theory starts with the premise, why would anybody go abroad if they didn't have to, right? Still fairly, I mean, I love going abroad, and I don't have to, but I do it because I enjoy it. But businesses have shareholders, and they don't get to do just what they enjoy. They're supposed to do something that makes sense for the shareholders. Here's the first idea to take away tonight that helps us get our heads around why this is happening. If we look at China's net international investment position, that is China's total claims on the world, holdings of assets abroad, versus the assets in China held by foreigners, right? Now that would be, General Motors' stake in its operations in Shanghai is a foreign claim on China, and Lenovo's holding of IBM Computer is a Chinese asset abroad. It turns out that China has a surplus of asset on net of $1.6 trillion, really big. So that's about $5 and change trillion of assets they hold versus $3.5 or so trillion that foreigners have in China, various sorts of investments. And yet, despite China's $1.5, $1.6 trillion surplus of assets in the world, every year China pays income to the world for its $1.5 trillion of net surplus position. They pay out income on that. There's a negative return on net on their asset. Why is that? That's because their assets globally are overwhelmingly in U.S. treasuries, which pay 1%, let's say, and the world's claim on China is overwhelmingly direct investments, which pay 10, 12, 15, 18% effective IRR on investment. And so even though China has a surplus position, it's losing income each year. China's aware of that. It hasn't been a first-order concern of policymakers in Beijing. It is a concern, certainly. It's something they think about quite a lot. But especially as China starts to go into a slower phase of growth now, think about how it's going to make money in the future. This differential return on investment stocks is becoming a very real concern. And it's a concern that exists that's finding its way down to the firm level as well. Let's talk about those two waves of Chinese investment I alluded to before. The first started around 2003. And it was almost entirely investments in resource extractive activities around the world, generally not in the advanced OECD economies, therefore. The exceptions to that, Canada and Australia, advanced OECD economies that have a lot of resources to be pulled out of the ground. Of course, the US is the big new player in that space too. We can come back to that. And we're seeing a big boom of Chinese investment in our shale gas and tight oil too now. But anyway, this first Chinese outbound wave was very much about resources. It wasn't strategic because as recent to that as 2001, Chinese planners had no idea they were about to go into a commodities super cycle of demand. They didn't understand their own urbanization boom that was just about to happen. They were caught unprepared for it, caught incredibly short in just about every basic material they would need for the coming decade of sort of peak infrastructure and peak urbanization growth rates and the years to come. And so Chinese SOEs, which were the ones in those sectors, took the opportunity to say, we're the solution to your problem. And by the way, we wouldn't mind having a taste of those oligopoly rents that come from being upstream and getting raw materials out of the ground, rather than just processing them and being told to sell them into the Chinese market, sometimes at a loss, because the central government was still controlling pump prices for gasoline, for example, petrol, and not passing through all the cost of a barrel, whereas barrel price was being set globally, was something China didn't have, was already in deficit by 2003. So that was the first wave. That didn't touch U.S. shores virtually at all, or Europe for that matter. One or two exceptions there. Lenovo, IBM happened in the mid-2000s, for example, but that was a very atypical case. The next wave, which we're seeing now, started around 2008, 2009. And that wave looks much more like consumer market-oriented investments outside resources sectors in pretty much everything else. Pretty much everything else in heavy equipment, manufacturing, food, services, all sorts of other stuff as well. The reason for this is that, well, there's a couple of reasons. One, of course, global financial crisis. Everybody assumes that's the end of the story. There must have been a fire sale abroad that Chinese companies were showing up wanting to make purchases. But China was having its own crisis internally in that demand was getting somewhat saturated for many of these companies. Their margins were starting not to respond to just building out additional capacity at home. And in the years just following 2008, 2009, labor costs started to go up rapidly. Environmental compliance costs started to go up rapidly. Chinese production of, say, apparel, socks and underwear, right, have a 70% market share in the United States, 70%. Of all the underwear we consume in America originates in Chinese textile factories. But what's the comparative advantage of Chinese textile? It's entirely labor cost related and scale, right? Chinese labor costs are now higher than Mexican hourly factory wages. Mexico is right next door. There's no transportation cost to speak of relative to bringing goods in from China. So for Chinese light manufacturers, right, which before had such a commanding edge in terms of COGS, cost of goods sold, that really the transportation cost didn't matter that much for them to at least maintain their commanding position in consumer markets, right? That was enough. For Foxconn, operating in partnership with Apple, right? We figured out that Apple was making like $400 for each $5 that Foxconn was getting for making iPhones. But still, Foxconn was seeing its margins grow adequately enough to keep that model going, up to the point post-2008, 2009, where the cost structure of operating in China just reached that critical mass point where it no longer was a crazy thing to think about moving downstream closer to that 50% of the global economy that was where rich world advanced consumers were. And that if they didn't do that, they were going to start losing that market share very quickly. Some other considerations that are becoming critical for Chinese firms right now that incent them beyond just the natural resources to start putting down bets closer to consumers in more advanced markets. The principal basis of competition, once you get to middle income and above, is your ability to innovate, manage a brand, protect brand value. All these things China actually doesn't do very well at all. while there's a huge amount of R&D spending taking place in China today, it's overwhelmingly being done by multinational corporations that know how to manage R&D effectively. And what R&D is being done in China hasn't produced very much transformative innovation, shall we say. That has everything to do with institutional conditions, the lack of IPR protection in China, for example. If you're a Chinese firm and you have a choice between trying to build your brand domestically in China, right, and hoping that pro-competitive, anti-predatory practices, regulators are going to allow you to extract the investment you make in a brand, right, versus going to Europe and trying to buy a known brand like Volvo and bring that back and add it to your product line, it's no longer a crazy idea for a Chinese firm to think about doing the hard work of going out there and figuring out how to manage that in an advanced economy. One more factor to add to the mix, by 2009, we really did have 100 million or so middle-class urban Chinese that were ready for that higher-end value proposition that Chinese firms were having difficult time developing indigenously. So the Shuanghui-Smithfield-Ham deal that's taking place right now is a fantastic example of that. Shuanghui is one of the best scale, most modernized pork producers in China today. And yet, premium Shuanghui product is not going to be able to command the same sort of rent as bringing in a Virginia ham. It's just going to take 10 years to build it rather than buy it. So there's a logic to this now. It's nothing to do with exporting to the United States. It has everything to do with bringing that brand proposition, that value proposition from an advanced market back to offer to a new kind of Chinese consumer at home. There are many, many, many difficulties and challenges in trying to do that effectively, profitably in the US or Europe or Australia for that matter. A couple examples of things that can go wrong on the way to the forum. Number one, you acquire a great going concern in California and you don't think to hire Mercer Human Resources to put in place a retention strategy. So by the time you show up in the United States to move into your new subsidiary, there's nobody there. All the people have left. They assume that because you didn't talk to them in the 6 months between striking the deal and trying to move in, that meant they didn't want to keep you, right? There's all sorts of things that you don't know. There's no endogenous learning about running a micro enterprise in the West until you actually do it. You can't just get a couple days of sensitivity training before you get the flight over and think that you know how to operate in a mature market. Secondly, we know of all the financial irregularities that have popped up around US listed and European listed Chinese firms that arise from the fact that there's just no habit of strict financial compliance with an activist financial regulator, securities regulator in the Chinese market. So, and on and on. All these things which were comparative advantages of a sort to Chinese firms over the past 20 years, that they were able to operate without the high compliance costs that our firms in the OECD were required to operate. I mean, your shareholders would kill you if you put at risk a valuable brand with all that goodwill on the balance sheet by neglecting to take care of your basic legal and regulatory obligations of the firm. I mean, it's obvious why you do that. Why you spend money on intangibles makes sense to us. It doesn't traditionally make sense to a Chinese business. A, because that's not the basis upon which the regulator is going to come down on them. There may be political issues at work, but it's not going to be due to a little bit of weakness or cutting corners on regulatory compliance issues. And secondly, if you do invest in a brand, right? One of my favorite examples, Chongming Island, north of Shanghai. It's part of Shanghai administrative area. It's a giant island. It's about 25 miles long by maybe 12 miles north to south in the Yangtze on the north side of Shanghai. It's mostly agrarian place. There's a little bit of industry there, not very much. And folks tried to develop it into what Marin County is for San Francisco, which is the feeder base of high-quality organic food feeding into one of the biggest metropolises in the world. I mean, why wouldn't you want to do that? If you had, a giant 200-square-mile garden right outside one of the biggest megalopolises in Asia, wouldn't you try to use that as the supply base into all, M on the Bund and all the other, great restaurants in Shanghai? Well, people did try to do that. They tried very hard, invested many millions of dollars into it. And there was one mushroom business in particular operating in Chongming. So Made in Chongming was designed to be a high-end differentiator for those firms. By the time Made in Chongming mushrooms made it to the Shanghai market, there were already counterfeit Made in Chongming mushrooms coming from hundreds of miles away that had very high levels of cadmium in them, of course, like everything else that's grown in China nowadays. So very difficult to recover the upfront investment made in a higher end value proposition in China today. Managing all these things, immensely difficult. So, I think enough said. I put the proposition on the table that when we see Chinese firms going out, we shouldn't just see that as the result of Chinese strength and competitiveness. Very often, it's some missing piece of competitiveness, something that can't be done so well at home inside the Chinese market that justifies a firm taking the additional risk of going out, having to do all this learning, and political risk as well for them. Chinese leaders have belittled Chinese companies for going abroad, saying, you can't even speak good Mandarin. How are you going to go speak French? How are you going to go speak English, right? That's not the kind of warm, encouraging, strategic support most people assume Chinese companies are getting. I joked, I don't know if it was with you, Hans, right before, no, it was with somebody else this afternoon, I think. There was an attempt to bring in a European automobile line to the United States market back in the 80s called the Yugo. Now, some of the older folks here might remember that. Yugos they were Yugoslavian, of course. Malcolm Brickman was the one who tried to make that happen. Well, as soon as they hit the market, they started blowing up and catching on fire and things like that. It only takes one or two new Chinese goods, right, companies operating in the U.S. to blow up and catch fire in the middle of Route 80 to really poison the market for made in China goods or coming from China companies for a very long period of time. So there's real risks here. We look at Japanese investment from the 80s and the literature on the experience of Japanese direct investors in the United States. It was often a decade or so before they got to the break-even point and started to become well-performing businesses operating abroad. China, we often think of as having this 100-year time frame for thinking about what's worth doing in the world. Absolute nonsense. Absolute nonsense. Very impatient culture. Chinese firms that can't claim anyway that they're doing well in Europe or the U.S. and Europe within a few years are really going to have a hard time. SOEs in particular. Private companies may well be a different story. But a lot of over-ambitious pressure to show performance overnight. Something else we haven't done in the Rhodium data, of course, is add a column that says, how are they doing? Well, you can't judge how they're doing in 2 years or 3 years, which is the average lifespan of a Chinese direct investment in Europe or the U.S. So far. It's going to take much more time than that. It took more time than that for foreign investors in China to break even and start finding their way to the men's room, so to speak. And we shouldn't expect Chinese firms to do very much better than that. Probably worse, in fact, because at the time when Japanese firms started going abroad to the OECD world, there were already dozens and dozens of Japanese brands that were known worldwide and respected. They weren't high-end brands. My first car was a Datsun. I had a Panasonic bicycle. I had a Canon camera at a fairly young age, right? And back in the 80s, they weren't top-tier brands. They weren't top-shelf stuff. But they were okay. And they were brands that you could work with. There are not 3 Chinese brands that anybody running a Fortune 100 company in the United States can name that a typical American would know. I mean, consumer goods, consumer-facing products that you'd be able to name. I wonder whether you could name 3 Chinese brands that the Australian, Joe Blow or whatever you call him down the pub would be able to say, well, that's a Chinese company. I recognize that as something I would have in my house or what have you. Ultimately, you might get to Qingdao beer at a Chinese restaurant, probably not anywhere else. Lenovo computer, which of course is a buy it rather than build it phenomenon, right? And I don't know if Haier is operating here much, but dorm room refrigerators, like every kid in college has his beer in America in a Haier refrigerator and might have a cheap window unit from Haier. Maybe they're a higher end brand here. I don't know. Let me stop with that, but just to turn things a little bit back to the upside in terms of how we're thinking about this inflow of Chinese investment in the U.S. I've mentioned Japan a couple times and drawn some comparisons. There are today, by our count now, probably about maybe 35,000 Americans who are working for these Chinese-affiliated direct invested companies in the U.S. That's not a bad number, 35,000. It's a good start. The number of Americans working for Japanese-affiliated firms in the U.S., 700,000. 700,000. So the conversation is starting to turn in the U.S., whereas mostly it's been cameras on senators in Washington talking about how much they have qualms about Chinese investment. As the job numbers start to pile up, as we get more comfortable with what it means to have Chinese firms operating in our communities, I think people are going to come around and are already starting to come around to focusing on the upside of what this phenomenon means. It's going to go on for decades, one way or the other. China's starting down a path of really significant reforms right now. We can talk about that a little bit if you like as well. If they get it right, we're going to see more and more competitive Chinese companies going out, figuring out how to be effective presence in the Australian market, European market, American market, elsewhere. And it'll be a good news story about a stable new flow arising from China's growth. If China fumbles reform and sinks under its debt load, which is a real possibility as well, we're also going to see a massive outflow of Chinese direct investment, but it'll be better thought of as capital flight than it will be as strong Chinese companies buying up assets on the block. Just in the past couple months, we've seen the GM building in New York bought for $700 million by a Chinese property company. Park Avenue Plaza on Park Avenue, $500 million late last year. Is that a productive investment in a going concern, or is that people getting their money the heck out of China before everything goes all wobbly? Well, that's a good question for debate and discussion.